Why your debt to equity mix matters. Hi, this is Josh Horn of Horn Valuation. I help owners build, value, and sell their business. Do you know what your debt to equity mix is? Equity is your ownership in book value on the business. Debt is borrowings from banks and financial institutions. Have you thought about that mix? How much in percentage of each in your what is known as capital structure? Have you thought about this? I'm going to break this down in simple terms and show you how you can think about this to maximize your cash flow and the value of your business. Let's look at company number one. Now, I've just boxed these debt and equity sections of their balance sheet, and they have $50,000 of debt and $187,000 of equity. And the equity includes the retained earnings in the business, the net income after taxes, and the dividends. So note that the debt to equity mix is 21% debt, 79% equity. And that in and of itself doesn't tell you a ton, but I will say that at first glance, this company is financially solid from a risk standpoint. They don't have a ton of debt. They have a fair amount of cash. And so that looks good. But let's think about this a little more strategically. If you were this business and how you might get at improving the value. So let's say this business repeats the same thing next year with net income and the dividends to the owners. The good news is the cash is going to go up approximately $81,000. The bad news is the business isn't growing. So what would you do? This business has a few levers it can pull. It can increase the growth of the business, increase the dividends to the owners. It could borrow more money. Whatever it chooses to do, the thought process needs to be on improving the value of the business without over-risking it, taking on too much debt. Let's take a look at business two. I flip-flop the debt and equity here. Business two has a lot more debt and a lot less equity. Exactly the reverse. Let's take a look at what would happen with business two if they repeat their same year next year. That is no growth. They're going to go backwards because in addition to not having any growth, their dividends are the same. They also have the debt principal to pay back, which is eroding their cash. This business has less options because of the debt. And unless they want to take bankruptcy or do something drastic there, the assumption is they're going to pay back this debt. They could either grow or reduce their dividends. So let's talk about how you might apply this to your situation. Number one, have a strategy. And that strategy should not be, we need stuff, borrow money. Think of it this way. When you need something, or you think you need something, the decision to buy it or what to buy should be driven by what cash flows it can produce relative to the cost of the debt. What's that mean? Well, if I can put a piece of equipment, a truck, a machine in service that can return me 10, 15, 20% cash flow return, and borrow the money at an after-tax cost of 3 to 5%, you can make money on that spread, right? That's the way to think of this. However, I do see some businesses that go out and borrow money to buy a piece of equipment, and it returns them zero or negative cash flow. That doesn't help you. And don't buy equipment and machines for tax deductions if they're not going to increase the cash flows of your business. Second, balance risk with return. Remember companies number one and two. Company number one had less financial risk because it had less debt. But recall, it wasn't growing at all. And so the return simply wasn't there. Now, the answer may not necessarily be to go out and borrow more money. However, if the first company can use debt to grow the business without over-risking it. It is a strategy. How about company number 2? Company number 2 wasn't growing either, and it had the heavy debt, which forced it into a limited number of decisions that it could make. So what's the answer? Well, the answer is it's probably somewhere in between for a lot of businesses. And it's going to depend on the type of business that you have, the type of industry that you're in. Your mix may not be consistent with the ones I showed you, but there's likely an optimal capital structure for your business to enable it to grow without over-risking it. And that's what you need to think about. Finally, think like an investor. Now, this is easier said than done, but think about what you would like to see if you were investing in a business. If you didn't own the business that you own now, what would you like to see? Would you want to see heavy debt and risk and no growth? Or would you like to see no debt, no balance sheet risk, but yet no growth? Probably not. You probably wouldn't want to see either one of those things. What you would like to see is debt used responsibly, used to increase the cash flows of the business, reduce the risk of the business, and increase the growth of the business, thereby increasing the value of the business. This is why your debt to equity mix matters. If you have any questions, please reach out to me. This is Josh Horn of Horn Valuation. Have a great day.